All right, what's up, everybody? Jack Ty McGuire here, aka Pierce Gaudreau, president of C&G Agency, a life insurance and financial services agency. Today in this video, we're going to go over IBC, which is infinite banking concept, how it works, when to use it, as well as breaking out an illustration for you. So, what is IBC? IBC is a whole life insurance policy, okay? Compounds uninterrupted over X amount of years, depending on when you're starting this policy, whether it's for you or maybe for one of your children or children's. You can have an ample amount of whole life and IUL policies, depending on uh, your income and your net worth. Okay. So you're able to fund these policies based on your financial situation and needs, which everyone's situation is different. Pull out loans against yourself at right now an average of 5% at the moment. Pay yourself back instead of borrowing against a bank. Hence the infinite banking concept, right? Uh, if you guys do want to read a book about this, there is a book by Nelson Nash, which I actually have that on my desk. Second, all the stuff out of the way. There we go. Oh, maybe. Okay, there you go. You guys get that on Audible, buy the hard copy on Amazon, whatever you want to do. So there is one thing that he said in this book. He said the more money you have in whole life policy, the more opportunity has a way of tracking you down, which I would agree. I could also argue that you have the same amount of money in your bank account, same thing applies, right? But having an ample amount of money in your bank account, getting you no returns, mm, mm, not really my thing. So, with that being said, if we're going to have capital that's liquid, excuse me, safe capital that's liquid, then we can make a strong case for whole life policies for getting your dollars to perform multiple different functions and looking at long term perspectives. It's a great asset to have in your portfolio. And the thing about IBC, a lot of people will get confused about. They always talking about when does my money meet my money. Well, it's not about that. It's not about rate of returns. It's about leverage and control. On top of that, there's a whole bunch of other benefits that come with it. And what it's going to do is going to allow you to become a better consumer because it's going to allow you to filter your purchases, make a lot smarter decisions on whatever you're buying or investments. Okay. Now, when can I use my policy loans and when can I not? There's no set rules in stone about this. That's going to be solely up to you. I can tell you again that it's about leverage and control. That's a main part of the concept. That being said, as your foundation builds, you can take more risks as the policy matures, right? All starts with foundation. Just like you're building a house, first thing you start with is foundation. We could also say it comes down to two things: life and math. If the math makes sense, use it. If you're wanting to buy a car, either for yourself or for your business, and the bank wants to give you an 8% loan, but you can pull out a loan against yourself for 5% and pay yourself back into that policy, then in that case, the math makes sense to use your policy, right? And if life happens, whatever that may be, and you need access to more capital, then you have the ability to use it. But one thing I will say is do not be the person pulling out 100 loans a year, not paying back your interest, and ultimately running the risk of lapsing your policy. Okay. Do not do that. Another example we could look at is if you're investing in real estate. Now, this is just random numbers, y'all. But don't freak out, keyboard warriors on me. But if we're investing in real estate and you could pull out a loan against yourself for 5%, but we were only going to get a 3% return, then obviously, mathematically, that wouldn't make any sense. Okay. But now, if we're going to pull out a loan for 5% and get a 20% return, then the math makes sense. But each person is different, and each person's value of control is going to be different. And what may be a smart investment for me may not be the same for you. Why is it? Why it's very important to understand what your value of control is. And what I mean by value control is the investment has to be greater than what your cost of capital is, or else the equation is not going to be positive and it's not going to be a smart thing to do. Um, Another common misconception by IBC is you could borrow at 5% while your dividend gives you 6%, which would be considered positive arbitrage, which it is possible to have positive arbitrages. Okay, it is possible. That's usually not the case in the early years, but as the policy matures and grows, it's definitely a possibility. But whether it's positive or not, that's okay. All right. And I will tell you why. So, a whole life policy with a participating mutual company means that you are participating in the profitability of that company, right? That's focused on getting you the best possible return with the least amount of risk. So again, with the risk on these policies, whether it's we're talking about whole life or IULs, is zero. So that means the market went down, it takes 5, 10, 20, 50%. You're not losing any money. Okay. It's not tied directly to the stock market. One thing to note is early policy years, the expenses will be higher. Okay. But as it matures, policy will be great. And we'll get back to the expenses. But a 6% dividend isn't what's fully credited to your net cash value. Now, I'm not saying the dividend is always going to be 6%. We'll just use that for example. But the dividend, before it's credited to your net cash value, right, is going to be subtracted by mortality charges and cost of insurance first. So giving you maybe, a 4 to 5% dividend. But as your money grows, policy matures, the dividends get higher, and along with the cost of insurance getting lower. I'm trying not to freaking sneeze right now. Give me a second. Going back to positive arbitrage, depending on the premium and the lump sum going into the policy is usually negative out the gate till about years 3 to 6, but gets substantially better over time. And why is that okay? Because there's much more to whole life policy than just rate of return. 0% risk, so you never lose any money. You have leverage, policy loans, accelerated death benefit, chronic illness, terminal illness riders. So the ability to have access to money that is part of your death benefit, which can be huge, right? It's a tax-free asset. Death benefit to your beneficiaries whenever you do pass. Safe from lawsuits, divorce, bankruptcy, IRS, etc., along with the stability of growth, and also has long-term care as well. So if we add all those things up, right, all the benefits, we could argue that whole life, assuming you got an IRR of 4 to 5% over 30 years, really gives you a 15 to 20% return with them. All those benefits add up, right? It's also very important to look at what chapter of the policy is a loan being taken out. So being taken out in years, 1 to 5, 6 to 10, 11 to 20, right? You can have positive arbitrage when your IRR is greater than your policy loan percentage. All right. Going back to LTC, which is long-term care, disability, terminal, chronic illness, that gives you access to your death benefit while you're still living, which I show later on in the illustration. Um, but what I'm trying to get at is if you don't have any of these living benefits, and God forbid any one of those things happen to you, it's going to just completely demolish whatever retirement account you have built up, along with more than likely substantially affecting your family members, since they will more than likely have to pitch in, right, and help. Now, I personally live in Texas, so these are just Texas numbers. You feel free to look up whatever state you're in. But in 2023, the median for nursing home was 85 grand a year. Assisted living was 47 to $61,000 a year. Home health aid was 54K, and there was plenty of cities at six figures. Dallas nursing homes were 107K. McAllen was 112. Midland 122. Corpus 126, and we can go on forever, right? But I think you get the point and see how expensive this type of stuff could be, and how huge it would be having the ability to have access to the benefit to your death benefit to take care of this for you and your family and not destroy your retirement account or those of your family. So as we look into the illustration, this is Lafayette Life Insurance Company based out of Cincinnati, Ohio. Let's go through some of the major stuff to talk to. All right, so this is John Doe. It's a male, age 30, standard, no tobacco. Initial annual premium, 11,133. Initial face amount, 154,926. And then one total lump sum of 25,000. All right. Let's go down to here. So this is important. So right here we got dividends, right? Nice and bold. We see dividends are not guaranteed. Why does it say that? It says that because by law, life insurance company cannot guarantee you a dividend. But I will tell you, Lafayette Life for the past 120 years has never once missed a dividend. So we can assume it's pretty safe to say that you're going to get a dividend, right? Now, policy loans. We'll go ahead and fly through this real quick. You can read it on screen, but I'll read it anyways. You can take a loan that is secured by the policy's cash value. At any time while the insured is alive, the policy is in force. You may submit a request for a loan that is secured by the policy's cash value. The loan must be in an amount when added to any existing policy loan is not greater than your available loan value. Your loan value will be less than the policy's cash value. Loans will be charged interest payable to Lafayette Life at an adjustable loan interest rate that we may change from year to year. The minimum loan interest rate is 0%, and the maximum loan interest rate is 8%. We recommend that you pay accrued loan interest prior to the end of a policy year. Any interest that is not paid at the end of a policy year is added to the loan balance, which will also be charged interest. Interest that you pay to us is not credited to the cash value of the policy, and it does not increase the cash value of the policy. A policy dividend, if any, may not be sufficient to pay loan interest. Loans may generate an income tax liability, reduce the cash surrender value and death benefit, or cause a policy to lapse. You may increase the risk that your policy will lapse, terminate without value if you take a loan. A policy loan or unpaid interest may have tax consequences. Now, that could sound scary and everything, right? Really not that scary, right? As long as you're not taking out 100 loans a year and not paying them back, and you're following the concept of being your own bank properly, you'll be fine. Okay. You're stupid with it. You're stupid with this and reckless, like you are your bank account. You could run the risk. Okay. But I want to make sure that was clear. So, with this being our initial annual premium and our total lump sum, it's important to note that right here, nice and bold, The initial 7-pay premium for the policy as illustrated is $36,146.27 per year. This is the maximum premium you could pay per year during the first 7 years without causing the policy to be classified as MEC. What is MEC? MEC is a modified endowment contract. To make it plain and simple, if this policy turned into a MEC, then it would no longer be life insurance, be considered an investment, and we lose all our tax advantages, which we do not want, right? Now, that 25 grand lump sum is what is allowing you to have this increase to be able to fund your policy each year. Now, if we didn't have that, this would be a lot less, right? 11,000 around there. Now, let's go down to, let's see where we're at. Let's make this quick. All right. So, we look at the first year. Policy's been in effect, age 31. Contract premium put in that first year is 36,133. Now, one thing important to note, the $25,000 lump sum, you don't have to put in right when the policy activates. Lafayette Life will grant you a 12-month period to put in whatever lump sum you're wanting to put in, right? If we're doing 25,000, then you have 12 months to do so, right? So we look at that first year, we come over here, and also before we get to that, you see guaranteed, non-guaranteed. We're focusing on the non-guaranteed side. So we're showing the dividends. We're focusing on that again because 120 years Lafayette Life has never once missed a dividend. So our dividend for that year is 2,365, and we have a cash value of 30,276. Now, if you were to put in that 25 grand lump sum right when the policy started, roughly Lafayette Life within 3 weeks gives you access anywhere from 80 to 90% of that money. Now, if you do the math, roughly that's the 82, 83% access to your money, right? And we have a death benefit of 706,000, meaning that you paid that lump sum and you paid that premium. Doesn't matter. I mean, you start paying that premium, you paid 1 month, you pass away the next month, your beneficiary is getting 706,000. Now, if we come down what? Year 6, right? We put in 11,133. We got an annual dividend 5,086. Add, subtract. We have an increase of 12,632. Okay. Well, hold on. We put in 11,133. We've got an increase right here of 12,632. So if we come back up here to year 5, even almost year 4, our increase is damn near and then already over what we're contributing into this account. So are we really even paying for this policy at this point? Right? Come down to year 10, we're 4 years old, put in 11,133, annual dividend 6,894, increase of 15,000. So remember, dividend. Get dividend of 6,894. Subtract mortality, cost of insurance charges. So we got an increase of 15,365, and we have access to $143,000. It's not bad. Okay. Now, say at that point you had a loan percentage, we'll say 5%, and you want to go buy a car, right? Bank of America said, "Oh, your credit is shit, and we're going to give you a 12% rate." Well, screw you, Bank of America. We'll pull out a loan against ourselves and buy our own car, right? Now, make this math a little simple. We'll say we did that, and we'll say the car was 43,000. Okay. So now we would have access to only 100,000 worth of leverage, control, and capital. But since Lafayette Life is NDR, non-direct recognition company, means that they don't recognize that you have the loan. They know you have it, but they don't recognize it. So we're still getting dividends based on having $143,000 in this policy and our cash value. Okay. Well, let's go down. Keep on going. Do a couple more years. All right. Age 50. Put in 11,133. Boom. Our dividend's $12,113. So you see back here at year 19, age 49, our dividends now are more than what we're even contributing to the policy. And there we have access to 318,000, a $1.1 million, $1,151,000 death benefit. We got a dividend of 12,113, increase of $24,092 with access of 342,000 and a $1,181,000 death benefit. Okay. Now keep on going. Let's say, okay. Let's go say age 65, right? Put in 11,843, annual dividend of 25,866, increase of 46,559. You put in 11,843 and you got an increase of 46,559. Now you have access to $861,000 with a $1.2 million death benefit. Now we'll say right then and there, I don't believe Lafayette shows the actual percentage, but say you did get a chronic terminal illness. So on top of your cash value, you would also have access to this death benefit right here. All right. And then after age 69, at age 70, we're no longer, this right here is 6,000. We're just paying for the rest of the cost of insurance for the next 5 years. All right. And then after that, we're done. We're not contributing anything else into this policy. Okay. So we'll say by age 75, we have access to cash value of 1.4 million, death benefit of 1.7. And say you live to age 90, you passed away, beneficiary would get $2.6 million in death benefit. Okay. So pretty straightforward. If you guys have any questions, comments, concerns, gripes, if you want to book a one-on-one appointment and tailor this to your specific financial needs for either you or one of your children, then you can find me on my socials on TikTok, Instagram, which would be Jacked Retirement Guru. You can go to my website, which is cgagency.net, and you can email me at info@cgcoverage.com. Again, email info@cgcoverage.com. Website is www.cgagency.net, and socials is Jacked Retirement Guru. Hopefully this video was a little eye-opening for you guys. Help break it down for you, and love to hear from you guys. Hope you have a great day, and appreciate you guys stopping by to watch my little video. All right. Much love, guys.